Hi, I'm Michael Carlin, president of Henry+Horne Wealth Management in Scottsdale, Arizona. Henry+Horne Wealth Management. That's right, you can see the logo. We've got a new company name. So we're real excited to bring this to you. It's the same organization, it's the same great people, it's all of the same great stuff, except we're bringing a whole suite of new technology that will launch in November. And we brought and negotiated a whole new deal with Schwab for reduced pricing. So with that, we've got a ton of information to cover in this quarterly market outlook, lots of data. So without wasting any further time, let's go ahead and dive into this quarter's market outlook. So the first thing we got to start with is we got to start with the tax cuts. If you're watching CNN, NBC, any of the major programs that are covering politics, what you'll see is a daily countdown about who's talking about what issues with the big tax cut. And you see those fingers that are crossed. And right now, the market expectations are absolutely focused on getting a major tax cut. And if we don't get one, the question is that what's going to happen in the market? What will the fallout be? What would the downside look like? It's hard to say. But I can tell you a few things. One, we certainly have had positive market movement in expectation we'll get something. I can also say that if we don't get a tax cut, what's likely to happen is the market's likely to have some kind of a negative downward swoon. To what degree, I don't know. I've read analyst reports that go as far as to say that there'll be a 25% massive correction if we don't get this tax cut. That seems aggressive to me. But please understand that there are some things out there that could affect the market, none more so right now than this pending tax cut situation, which will go through some of the data and insight and information and what you can expect economically speaking there. We've also got another picture of David Bowie with the changes that are going on with the market, because this tax cut is a huge change. We haven't seen anything like it in decades. And if it does end up happening, this kind of sweeping reform on individual and corporate tax side is something that we haven't seen in a really long time. Again, we'll talk about it a little bit more when we go through the data, because what we're seeing is that there's a number of other Trump agenda items that have stalled. There's been a lot with immigration reform and things like that just haven't gone through. So while we're seeing part of this Trump agenda, these Trump campaign promises that are coming to fruition right now, potentially with tax cuts, we're seeing a lot of other agenda items stalling, which is increasing the pressure in Capitol Hill to do something. This tax cut's a major something that we'll have to see if it's going to happen over the next coming weeks. Deficit spending is up. You know, there's a lot that happened since we met last with regards to climate. I do talk a little bit about climate in this presentation here, and what I would point out is that it's hard to digest a tax cut anyway, because what it does is it's going to increase our deficit spending. But what's already increasing our deficit spending is what the government has pledged and promised for hurricane relief funds. So, my goodness, hurricane relief, increasing deficit spending, potential tax cut to increase deficit spending, look for the hurricanes and climate issues to be part of a challenge and a hurdle that the government's going to have to get through in order to get those tax cuts passed. So with that, let's dive in to talk about how the market performed. Look at some of these numbers. Look at the middle of that chart, January to September. The U.S. market up over 14% for the first 9 months of the year. Now that 14% refers to U.S.-based, large cap, big companies. Great start to the year. Very much unexpected. You know, so first question is why? Why that? In small stocks underneath that, why they're up 10.9%? International stocks up 20%? Why? And emerging markets up 27.8%? What is going on? What did I miss? Is the economy that strong? So first things first. If you recall in November, after Trump won, immediately after he won, the market went down 700 points because it was just thought that, oh my gosh, the economy is going to be over. Not true. And what we have seen after that initial shock is that the market has gone up significantly. It was up in November and December, and certainly the first 9 months of this year. A lot of that has to do with the fact that there's uncertainty that is no longer uncertain. We now know that Trump's the president, we understand policies, and we're understanding some of the objectives that he's going after. So lack of uncertainty, which is Certainty leads to the businesses doing what they need to do, market moving forward, and as a result, corporate profits have been outstanding. So that's the main reason why you're seeing a lot of this surge. The second reason is that you're seeing a really nice recovery in Europe. Look at that chart. Again, it would be on your right-hand side. It's that full year 2016 returns. Look at that 1% for international. International investments did not do great last year. The biggest issue is that there was a lot of economic uncertainty. The economy didn't grow overseas as much as they had hoped. And what you're seeing in 2017 is finally a resurgence internationally. So with the international markets resurging, those economies overseas growing, and you've seen some help from the US dollar moving in the right direction to make international investments move up, you get a phenomenal year for international investments. The other information on the chart, what I just want to explain is that, my goodness, whether it be different types of bonds focused in credit, government bonds, or alternatives, so many areas of the market have done really well this year. A lot of our strategies have continued to work, but now's when we have to be extra vigilant. Now's when we have to really start to figure out, market's been up a lot. Is this the kind of thing that we need to start to be a little bit more cautious about? And we're going to talk a lot more about that in some of the data, but we are excited and we're pleased with our results. If you're not a client of ours, we're happy to help you look to figure out what happened and why you didn't get the performance that you needed or that you were looking for. And so we need to figure out how cautious we need to be and how strong the economy is going to be moving forward. We're going to talk about these 4 pillars. There are 4 pillars, like 4 legs of a table, that are holding this economy up. And the first being global growth. I just talked a little bit about it. We've seen an improvement internationally. US growth has been pretty good. But if you're looking at these kind of the big G7, the big 7 largest countries, the largest economies in the world, how are they performing? They're doing pretty well. You're seeing better growth globally when you're looking at GDP or gross domestic product, which is great. So the first leg of the stool in global growth is, albeit we're not growing at a rate that is unsustainable and super high, it's moderate and it's stable and it's predictable, which is good. We also have low inflation. Inflation, again, that's the cost of goods going up every year. And if you have super high inflation, that can be very detrimental to an economy because it can slow things down. We haven't had super high inflation. In fact, globally, with these big countries, inflation has been pretty low. We've been averaging right around 2%. And 2% is very sustainable, it's very reasonable. What it shows is that you're getting a little bit of price improvement, you're getting a little bit of wage improvement. So as prices go up, businesses can make a little more, and as wages go up, people can consume a little bit more. That's a great relationship, but not so much so that it's slowing down the economy, and it's certainly not deflation, or you're selling things for less, you're making less profit, you can't afford to pay people as much. Deflation's difficult, but inflation, it's been smooth, it's been easy. That's another solid leg of this economic situation that we're in right now. The third is monetary policy in the United States has been becoming a little bit more restrictive, and by that I mean the Fed's been increasing interest rates. The Fed is no longer buying and expanding their balance sheet. So those are 2 accommodations that our Fed here has been restricting. But interest rates are still low, which is very accommodative. And if you look across the world, Federal Reserve institutions across the world are very accommodative. So my goodness, that's another leg of the stool that's very positive. And then the third is, again, that non-traditional monetary policy. You start to look at some of the things that the governments are trying to do, lower taxes, business reforms, those kinds of things. That's also been very accommodative. So goodness gracious, you got 4 legs of the stool, all of which supporting this economic situation that we're in right now. This is the reason why, fundamentally speaking, because of the solid foundation, these 4 legs, why we're okay with the market at these levels. It doesn't feel like to us at this moment that things are so wildly overvalued and they're irrational. So we take that as a very good sign. Now we're going to switch gears and we're going to talk a little bit about other key economic data points. I've got 3 charts on this slide. I want to talk about inflation, which we talked a little bit about. I want to give you the data, unemployment, and GDP growth. Look at that first chart, that inflation chart. And what you'll see is that going way back when, going back to 1914, there were pockets where we had massive inflation And there were pockets of time where things in buying things and wages were very unpredictable. It was hard for businesses to plan long term. And our U.S. economy, as it's going through that industrialized start, it was kind of like reading a Richter scale for an earthquake, something like that. And then you can kind of look and focus, really from like the late 80s all the way through to today, inflation's been pretty stable, pretty predictable, and pretty reasonable. This is something that you want to look for, because what we absolutely want to see is we want to see a nice positive low level of inflation, and we do want to pay attention to what that impact is on wages. We want to continually see improvement in wages, and we want to see a a little positive inflation so businesses have the pricing power to continue to make money and have nice margin. On the unemployment side, it's great news, but at the same time, there's a little bit of concern for me. Let me explain. If you look going back, and this chart goes back all the way to before 1950, you're going to see there's this kind of cyclicality to unemployment, in that we'll have periods where we'll have a recession and we'll have high unemployment, and as the recession ends, employment will become more full. Look at the point where we're at right now at the bottom part of that chart. What it shows you is that we're really at this almost full level of employment. Full level of employment. What that means is that can things get that much better from where we are right now? It would indicate to me, at this point where we are at this time, there's been several other periods of time historically where unemployment kind of seems to get to this level and then peters out and starts to turn around again. So economically speaking, I'm very happy where we are now with our employment situation, but I do look at this as a trend to say, let's look for this reversal, and let's hope that that doesn't happen. And on the bottom chart, we're going to talk a little bit about GDP. In GDP growth, the magic number is what Trump wants, what politicians want, what consumers want, what business owners want. What we're all looking for is 3% U.S. growth or better. GDP, again, it means gross domestic product. It's the sum total measure of all of the goods and services that we're able to produce in a year. Right now our total GDP is about 20 trillion. And there's nothing more than this president and again, and those business owners and consumers would want for that $20 trillion U.S. economy to grow to $22 trillion U.S. economy, and then a $30 trillion size U.S. economy. And that would be great for that to happen, but we need a lot of consistent 3-4% rates of growth in order to get there. But if you look, that blue line indicates, that's how often do we get over 3% growth? And if you look back through history, going back decades and decades, it doesn't always happen all that often. Even more troubling is that if you look back over this more recent time period, what you'll see is that we have had short quarters where we've peaked over 3%, but nothing long and sustainable. We're watching that gross economic output. We encourage you to do the same because, again, that rising tide will lift all boats if we see improvement with GDP. We're going to talk a little bit about the US dollar index. I mentioned it when I talked about the international stocks. So if you look at the story of the US dollar index, what you'll see is that in the early 70s, the decision by the government to get off the gold standard allowed currencies, the US currency, to finally free float. The thought was is that, if we have a free floating currency, what will happen is the US dollar should sink. It should make our goods and services less expensive so that we can export and sell more of our stuff worldwide. This will be a great win for the US economy. It will help us. Well, lo and behold, currency free floated, and then you can see shortly thereafter the US dollar did indeed fall. It did help with some level of exports, but understand something is that it wasn't the kind of thing that overnight was an overnight success for businesses and for consumers. But we did see that level of improvement. But no sooner did that happen than we had rapid and huge inflation. Rapid and huge inflation. And so the interest rates had to go way up in order to combat inflation, and as a result, as interest rates rose, the US dollar index rose, making our dollars more attractive to people all over the world because they could buy our treasuries at higher bond rates and all of that stuff happening. What we saw is that our currencies got to a certain peak of demand and then slowly subsided decade after decade and it's really been in a period of slumber. So why we're talking about the US dollars, because there's been a really interesting thing that happened when Trump won. When Trump won in November, the US dollar index, if you can see in November, had a surge higher because there's this expectation, America first. In America first, of course he wants a strong dollar. And what we found in 2017 is that's not really part of the president's agenda, which is fine. And as a result, the US dollar index has dropped 8.5% so far this year. Interesting. So that 8.5% drop, that's going to help a lot of companies. It's going to help your McDonald's of the world. It's going to help all those global companies, your Procter & Gamble's, others that are selling their goods all over the world. And now their goods are more reasonable. They're less expensive because of that cheaper US dollar. Especially, again, to places all over and outside the United States. So that negative 8.62% drop that we have had this year, you can add that as a positive rate of return to your international investments. So before we get so excited, I mentioned that our international investments are up 30%. You know, the broad part of the international market's up over 20%. Emerging markets up almost 30% themselves. A big part of that is the fall in the US dollar. It's a big component. Want to make sure we unwrap that mystery. So more data, more data, more data. Let's look at the real estate information. There's a couple things I want to cover. I want to cover commercial and residential. On commercial, look at the commercial foreclosures 1991 to present. What do you see? It's the same kind of thing you see with the unemployment measure that I showed you before. We're at this historic kind of all-time low for very few foreclosures, commercially speaking, and that should surprise some of you because if you remember from our previous market outlook, I mean, look at Sears. Look at those, big department stores that are closing and franchises that are closing and things. We're seeing tons of foreclosures and tons of commercial companies that are going out, but if you're looking overall, the amount of foreclosures as a percentage, even inclusive of all that's happening with Sears and others, is still historically very low. So that gives us a little bit of a cause for pause to say we know that we're at a really good time, historically speaking, with commercial real estate, but that gives us a little bit of caution that maybe this is as good as it gets and that more difficult, more challenging times are coming. So those are the kind of things that you want to identify, you want to see, and you want to be able to successfully navigate. So you're going to want to own really quality commercial real estate moving forward, especially given those dynamics. On the residential side, it's a very different story. Residential real estate prices, if you go back from 1980 to today, you've got a variety of data. Well, what I want you to see, big picture, is that prices are almost where they were right before the last real estate correction that we had. Now, that's not a measure for your neighborhood. That's a national measure. Maybe your neighborhood's more, maybe your neighborhood's slightly under, but the point is that nationally speaking, we're right there price-wise. So if you're going to be buying a house, what I would say is let's look at this national measure and say, my goodness, maybe home prices continue to improve and we set new highs, but certainly a lot of the money that could be made easily in residential real estate likely has been made. So be cautious and careful with your residential real estate, and if you're looking to sell, that's another thing to look at to say, geez, maybe this is a reasonable price for us to sell at and to transition and to move into something different. And again, the residential real estate foreclosures, we still have some foreclosures. The rate of improvement has been there, but we're not at all-time bottom levels. That's a sign that there's still more room to run favorably with residential real estate. But I think really, commercial real estate, residential real estate, the sum total is we've seen a lot of great pricing, a lot of great pricing improvement. Maybe time for you to think about being cautious, conservative, and doing the right thing for your family long term. We're going to talk about taxes, the U.S. economy, and our future next. Let's get right into the debt to GDP ratio. We've talked a lot about it. That's that big purple graph here. Here's what I want you to know, and that many of you may not know. Back in World War II, our total U.S. debt to GDP was even worse than it is today on a total basis. Right, so again, we have a $20 trillion economy today, and if we had 100% debt to GDP, we'd have $20 trillion of U.S. debt. And The US economy was a lot smaller than 20 trillion back in the 1940s, but the debt to GDP was a 100% match. It took decades. Look how long it took for the debt to GDP to slowly fix itself. It fixed itself in two ways. One, the total indebtedness was slowly reduced, but more than that, the US economy grew. Imagine this, we're 100% debt to GDP right now on an aggregate basis. Imagine if that's where we were right this second. Imagine if our US economy grew to 40 trillion and our US debt stayed at 20 trillion. Our debt to GDP would go from 100% debt to GDP to all of a sudden 50% debt to GDP. So there is a way we can grow ourselves out of this debt problem. We've got a long way to go, and unfortunately the CBO, the Congressional Budget Office projections, show that a continued and rather steady increase for our total US debt to GDP ratios. And this is a concern because the more deficit spending that we do, again, there's hurricane relief, things that we've got to do, tax reform, those are things that we would like to do. Those all add to our debt and deficit quicker. So we've got to be really cautious because we are borrowing to grow. And we really want to make sure that the US government doesn't get too far out of whack with our borrowing to grow, because at some point, our ability to borrow may be forever changed. We could talk more about that in future market outlooks, but understand this. Look at Japan. Japan's debt to GDP ratio is over 240%. Their interest rates are at 0. So imagine as a retiree trying to make things work in a zero interest rate environment when you need income. It's not easy to do. So we can go ahead and continue with this borrowing path, but we just need to be really cautious. And so I think that the deficit hawks and the debt hawks are going to have a little bit of a thing to say about this tax reform. We'll get more on that. But it's something that we are watching and you need to watch as well. One of the things that I'd point out in these other two charts, and I realize that the font is small, but the big picture is very, very bright, is that on the top chart, what you'll see is corporate tax rates are often maligned by politicians saying we have the highest corporate tax rate anywhere in the world, over 35%. And if you look out of these developed countries, we are and undoubtedly do have the highest corporate tax rates in most parts of the world. Okay, we get that. Understand something though, is that if our average corporate tax rate is supposed to be 35%, corporations, their average tax rate, what they're really paying, you think it's 35%? You think it's 30%? It's 18%. So if the average corporation is only paying 18%, how do they get there? There's tons of deductions, tons of deductions. And certain industries have more deductions. The corporate deductions are going to vary by the company's industry that they're in. If it's an industrial company, they're going to have fewer deductions. If it's something that's in the healthcare space, they're going to have more deductions. So it really depends which side that you're on. If you're an energy company, you're getting massive deductions for intangible drilling costs and a whole bunch of things related to depreciation that make your business work. But you're certainly, as an energy company, not paying 35%. In those energy companies and those healthcare companies that absolutely rely on those tax deductions that will be lost in this corporate tax reform, look for them to fight to say, no, we don't want corporate tax reform. So you're going to have a bunch of organizations that say, no, we don't want that. You're going to have a bunch of organizations that don't get a lot of deductions that are going to say, we need this in order to compete. It's going to be a muddy process, but politics always is. Look for more of that. There's also the tax burden on U.S. workers. So where do our individual tax rates fall in the rest of the world? And you can see that we're not the best in the world. We don't have the least amount of taxes anywhere in the world. But you know what? We're pretty darn competitive. So we're high on the corporate side. We've got a bunch of deductions that make it more affordable. And on the individual side, we're not all that bad. So as we look at some of these things with tax reform, I don't want there to be too much excitement about how it's going to change the world. I know the market's excited about it, but before we start to throw the ticker tape parade and get excited that something's going to happen and change the way we live, let's look at some of the facts. There's a historical impact of tax changes. Let's take a look. We can go back from Reagan's tax cut in 1981. And you can look at different tax cuts and different tax increases, whether it be Reagan, Bush Sr., Clinton, George W. Bush, Obama. Look back at history. And we should get a really clear definition of, well, we would expect every time there's a tax cut, the market should go up, and every time there's a tax increase, the market should go down. No, that's not at all what this says. If you look at the SPX, or how the market did 1 year later, look at those results. All but one are positive. This is the message. The message is the market likes certainty. Certainty. And when the market understands the rules, the market and businesses can participate and find a way to navigate around those current rules to maximize their businesses and their opportunities for growth. The market does not like uncertainty. If they don't know what's going to happen, then they tend not to do things, they tend not to grow, they tend not to invest, and those kind of things can hurt the U.S. economy. But this is concrete proof. Tax cuts or tax increases, there's no definable impact. So I understand that the market's been excited that there's going to be this tax relief of some kind, and the market's risen. I know that there's an expectation if we don't get that tax break that the market's going to collapse and fall. But before we get too excited about either one of those two things happening, let's understand certainty is what the market likes, and certainty is what will push us forward. Let's take a look at the tax plan overview. I got the red and I got the green. Let's start with the green first at the individual side. What the government's proposed that we do is they propose that we simplify the tax code, and they want to get rid of a lot of the complexities, and they want to shrink the number of tax brackets down to 3. They left the possibility open for a 4th on the ultra high net worth side. We'll see if that happens. And also keep in mind that the rules still haven't been finished. This is just the outline, and I'm sure even as I'm speaking today, the government's planning something slightly different than what's up here on the screen. They're talking about doubling the deductions, but again, eliminating that state tax deduction. I want to highlight states that have lots of income taxes, like New York and California, love deducting the state income tax that they pay because it's a huge form of relief for them. But there are plenty of states that either don't have a state tax or have very low state taxes, and so those deductions mean very little to them. So, Nevada and Florida being 2 states that don't have a state tax. So you've got competing interests. New York and California would say, no, we absolutely, as individuals, need to deduct our state taxes. It's very important to us. And from Florida and Nevada, they're saying, I don't care. Let's go ahead. Get rid of it. I don't care. So again, you're going to have lobbyists, forget Republican or Democrat, it's going to vary by state to determine what's going to stick and what's going to stay. But overall, what's been agreed to is $500 billion of more taxes being paid by individuals is what they're expecting. Now in red, these numbers seem to be, they're varied, but the conservative estimates that I tend to believe is there's a $2.6 trillion revenue loss if we give corporate tax relief. I've seen estimates that go as low as $1 trillion of lost revenue if we give corporate tax relief. And much like on the individual side, you're going to, as I said, have corporations that say, oh no, we absolutely cannot afford to get rid of these kind of deductions because they want to get rid of immediate deductions for corporations, and they want to get rid of certain depreciation allowances. A big one, a massive one, and it's actually a black swan event. And so I don't really want to comment a whole lot about what this black swan event could or couldn't be, but I would say that if the bond interest deduction is removed, it's going to likely very much dramatically reduce the amount of corporate bonds that companies are going to issue. And if that happens, you get this kind of market event that in terms of size, maybe as much as 2 or 3 times the size of a Brexit. It could affect a lot of jobs in and out of the financial community, corporate community, and could affect GDP significantly. So that bond interest deduction could have a ripple effect if it's removed that would incentivize corporations to use stock to grow rather than bonds, which could change a lot for a lot of people. So if you add the $500 billion gain and the $2.6 trillion loss, it's likely a $2.1 trillion loss. Again, some politicians are saying the loss may be $1 trillion, but then you got to factor in what they call dynamic scoring. And what dynamic scoring is that, no, Michael, what's going to happen is that when we have these deductions, corporations are going to then have more money, they're going to reinvest, they're going to be hiring more people, they're going to be doing factories, and all of this stuff's going to put more money in consumers' pockets, and we're going to get growth. So you can't count it as a negative 1 or 2 trillion, it's going to be a net positive. Prepare for the fighting on dynamic scoring. I've never seen a congressional budget office that's been able to give me a dynamic score that's been historically and perfectly accurate looking back. We're going to get a lot of reports and we're going to get a lot of data because there's a whole bunch of scuttlebutt about what is or is not going to be included in this tax reform. Watch the news. It's going to change every single day. And watch the news because depending upon the state you're in, depending upon the type of company you work for, they may be pro or against this tax reform. It will be something that's less Republican and Democrat and more specific to who you are and what your life looks like. This could be a major sweeping reform that would have major changes that we haven't seen in decades. Let's go see if it happens. There's a variety of scenarios that could happen with tax reform. Some are good. The market could rise 11%. GDP growth is 2.5% and growing. And the downside would be because a big part of that tax relief would go to the high net worth individuals, there would likely be more income inequality. We would love to see income equality from an economic standpoint. We want to see consumers with the ability to spend, high paying jobs, all of that stuff. I don't think it does a lot to help income inequality. We'll have to see how that comes through. We've also got the tax cut gridlock. If that happens, again, competing interests, different states, different companies, different sectors saying, we can't afford this, we want this, and then nothing happens. The hopeful thing is that the market may disregard it. The market may disregard it. That doesn't mean there's a short-term negative impact, but likely the market's relatively flat as measured in yellow. That is, I think, the more likely outcome if nothing happens. Again, I've read a bunch that shows there'd be a 25% correction if nothing happens. I think this is a little aggressive. We're going to have to wait and see. And then the other is that black swan event that I mentioned before, is that if corporate bonds dry up, if that does indeed happen, that could be a significant hit to the market, a significant hit to GDP, which is 2% all of a sudden becomes our upside, and then corporations switch from stock to bonds, which has a whole bunch of different effects, including the dilution of many of the stocks that we currently hold. We certainly don't want to go there, but the good news is that that ugly scenario is also the least likely. Let's spend a few minutes talking about climate. One of the things that's a little confusing is that it seems obvious to most investors and to clients when they call to say, you know, Michael, we've had a tremendous hurricane season in the United States. Houston, Florida, Puerto Rico. Massive damage, billions of dollars. This has to have a negative impact on the U.S. economy. We're going to unpack that. We haven't seen that historically. We're not seeing it now. And in fact, if you saw many of the insurers, their reaction when this whole thing happened, both in Houston and in Florida, and even in Puerto Rico, insurers, the stock performance has actually been quite good because the damage hasn't been as extensive as it could have been. And insurers are very much aware and they do prepare for these kinds of things in as much as it may be shocking. They are prepared for them financially. So I want to talk about the short-term impacts with agriculture and the long-term impacts with things like potentially the sea level rising and how this relates to the market. Let's just talk about the long-term impacts really quick. If you look at a variety of different surveys, and I put 3 of them on there, you know, there's the IPCC or the FINRA report, you look at some of those, and they're going to give you varying degrees with how high they think the ocean is going to get. And we put that chart of a 6-foot human being to give you a measure to be like, well, at what point is that sea level going to rise? And there are some reports that think the sea level is going to rise as much as 6 feet by the year 2100. There are some that are more conservative that say that the ocean may rise somewhere around 1 foot by the year 2100. Point is that the ocean level rising, the market doesn't dispute it. The market just says it's way too far off into the future for us to price it into the stock market and the economy today. Keep this in mind. The market only looks out 6 to 9 months. So let's not be surprised that something that's going to happen decades from now hasn't been priced into the market. So the agricultural impact with this whole climate change, one of the things that we've noticed, and that I'm sure you're noticing, that you're seeing or reading about, is that places where they used to grow things in mass are becoming too hot to grow, and we're seeing this change. But what's interesting is that there are places where are going to become more apt to grow things with climate change. And you look at that map, let's focus on the United States. You see the areas in the Pacific Northwest that are dark green, and all the way from the East Coast to the Midwest, that northern part of the US hemisphere, you're seeing in green. What that is there's an expectation that those areas you'll be able to grow more. Where the parts below that green line and the orange and red, you'll be able to grow less as we continue to see more climate change. So there is this balance. There is absolutely an evolution where the places where things are grown is going to continue to evolve and move. It doesn't mean that there's no place on Earth where you can grow things, but there are certain places that are likely to struggle more with climate change. And this map does a really nice job indicating what some of those places are. And as we've had climate change, you'd expect, oh my gosh, the crops in Florida, the orange crops got decimated in the hurricane, or with all of these different areas with lack of rain, lack of water. As all this is happening, there must be explosive pricing pressure in the price of food. This should wreak havoc on the price for food. Not true. What you can see, you can go back 10 years or more, and the price for food, which is measured by the CAGR, that index, has actually gone down 2.5%. It's gone down 2.5% because of technology. So, understand this. Climate change used to be thought of that the price for food is going to be outrageous, but what we've seen as the climate has changed, we've seen the price for food actually drop, agricultural prices drop, and a lot of it has to do with technology. The final point on the climate is, and I mentioned, is there a link between the stock market going down and a whole bunch of different economic crises? And if you go back, Hurricane Andrew or Hurricane Katrina or Charlie or others, and you go back through history, what you'll see is there really isn't a direct link between having a massive weather-related event and the market taking a hit. In fact, other than in 2008, Hurricane Ike, which also happened to be coupled with the financial crisis, we've seen weather-related events being a net positive for the economy. If you look at things like the hurricane wiping out tens of thousands of cars in Houston and Florida, all of a sudden those automakers have a little bit of a relief where a lot of automobiles need to be replaced, and auto parts manufacturers, the prices for those stocks have also gone up as well in anticipation that there's a whole bunch of car repairs that need to happen. So don't look at the climate change as something that's going to increase agricultural pricing. Don't look at the climate change as something that's going to necessarily decimate the U.S. economy. In fact, in lots of cases, it's net positive. Okay. I want to change gears and spend a little bit of time in talking about technology and technology stocks. Technology stocks were originally made famous right around the time when I got started in the industry in the mid-90s. In the mid-90s, everyone thought they were the most brilliant advisor on the planet because all you had to do was buy anything with a technology name to it, anything that had a .com at the end of it, and the stock price went through the roof. This is called the .com bubble days of that mid to late 1990s, where the price for things hit a hysteria. Companies didn't even need to be making money in order for the stock price to surge. So if you look at the average PE ratio, or price to earnings ratio, of some of the big companies at March of 2000, which was like right at the absolute peak, the very end of that .com bubble burst. Look at things like Cisco with a PE over 200. You're looking at even Microsoft with a PE somewhere around 75. These companies are trading at 75 times for every dollar that they earn, or 200 times for every dollar they earn. That is a type of irrational pricing that just didn't make sense. And those were some of the big guys. Again, as I mentioned, there were plenty of little companies that weren't making any money that were trading at very unrealistic valuations. Now, fast forward to March of 2017, let's look at the big ones. And we'll look at the Facebook and Apple and Google and Microsoft. Now, Microsoft today, their PE multiple, somewhere much more reasonable in that 20 to 30 range. Apple is right around that 15 range, and Amazon's the big holdout with that very, many would call irrational PE multiple into the hundreds. So what you don't see today, what you saw back in the early 2000s, late 90s, is you're not seeing completely irrational stock prices in technology. What you're seeing is good earnings growth. You're seeing huge market share increases. You're seeing profitability in revenues. You're seeing a lot of great things as technology companies are changing the way that we live our lives and the way businesses do business. And that's added a lot to their stock price. It's added a lot to our economy. And with that, I don't see us today being at these crazy, unrealistic valuations that just don't make sense. But speaking of something that is priced very irrationally and that may not make any sense, let's talk about Bitcoin and cryptocurrencies. A cryptocurrency in Bitcoin, if you don't know, is a technologically invented new currency that currently is not tracked or traced by any government. And it's a very popular tool that's used by young business upstarts that are trying to do new and innovative things. There's just people that want to be off the grid. And if you take your currency, and it could be a euro, it could be a US dollar, it could be a Chinese dollar, and you convert it into Bitcoin, you can take your Bitcoin and buy certain things. There are even homes that have been for sale in Bitcoin. There are certain things, buy a plane ticket on Virgin Atlantic using Bitcoin. So there are some companies that take it. It's a new form of currency. It's supposedly unhackable. Right now, it's on some levels untraceable. So as a result, its adoption has just taken the share price, and it's up 35,000%, going back 6 or 7 years. It's been incredible. So with that price increase, obviously enter the news. So the news has picked it up and says, wow, this might be something real. And as it's increased, Jamie Dimon who is the CEO of JP Morgan, Prince Al Wahid of Saudi Arabia, both of those big industry leaders have come out to say Bitcoin is not something that's real long term. Bitcoin is something that at some point needs to be regulated. Bitcoin and other cryptocurrencies have gotten way ahead of themselves. Listen, when you see a chart like this, it's hard not to believe that the currency is just priced irrationally. What I would say is this, it's not impossible to create competing currencies to Bitcoin. There are already a number of competing currencies to Bitcoin. It would make sense that there will be many others priced more reasonably within a more rational framework that may supplant Bitcoin, and this may be something that unravels in fantastic and historic fashion. So if you bought Bitcoin, you made money, good for you, but be cautious. So before we get off valuations, let's just look at this from a more specific perspective. Let's look at the US large cap, mid cap, small cap. Let's look at the international markets and see how out of whack and overvalued they are by size and by country. So the US is currently trading at 19.3 times forward-looking earnings estimates, which is pretty lofty because the 20-year average is 16.5. That's not as crazy as it used to be. I mean, there are plenty of periods of time where the market's trading at 30 and 40 times forward earnings, so on balance. So before we get too excited to say, oh my gosh, it can't get more, it can't get worse, it certainly can, and it certainly has. So I don't view that as particularly alarming. It seems it is high, but it's within reason. The mid cap and small cap also, again, trading at a higher multiple to forward earnings today than they have historically been. Again, we've got the 4 pillars of our US economy that are strong. We've got a lot of different things working for us economically, so it's okay that they're trading at a higher multiple. It makes sense. International markets, there's a little bit less of a premium there, which is a good thing. So if you're looking to decide whether or not international markets are completely overvalued, overpriced, should I race for the exits? No. Maybe it's time to take some profits? Yes. But they're not even as overvalued, historically speaking, as the US markets. And you look at the emerging markets, a little bit more of the same. So point is, yes, we have a little bit loftier valuations. Because of the relative strength of our economy, that's an okay thing. But what you got to keep in mind is that stocks that are getting these valuations are also benefiting from one thing very important. Where else are you going to go to invest your money? There aren't an unlimited number of places to go to say, where am I going to get income and growth? And the stock market just happens to be a better place than the bond market. The bond market, they're facing higher interest rates. They're facing some pressure there, certainly here in the United States. So where are you going to go? There's plenty of companies and stocks that are paying these 2.5%, 3.5%, 4.5% dividends. And hopefully the stock price can go up in addition to that dividend. So with that kind of performance, and a bond that's only paying 2 or 3%, it's no wonder why people are turning to the stock market here in the United States and overseas compared to a lot of bond markets. So we're going to see loftier valuations because where interest rates are. At least the economy is strong. It's built on a solid foundation. We're going to watch for weakness in the economy to see if there's a change. And with that, we need to just take a historical look to see how out of whack this is. Let's talk about whether or not we should be worried about a correction, because it's been a long time since we've had one. But how long? So historically speaking, we have a correction of 5% every 10 weeks. It's been 64 weeks since we've had any kind of event that's taken the market down 5%. Way overdue. Corrections of 10% or more, we have them historically every 33 weeks. It's been 83 weeks since we've had a correction of 10% or more. We're historically way overdue. A correction of 20% happens historically every 127 weeks. It's been 432 weeks since we've had a correction of 10%. Wow, okay, what does this mean? It means that we are absolutely due for some kind of a market event, some kind of correction. I don't know what the event that's going to be that triggers it. Remember that whole tax cut thing? Maybe if that doesn't happen, we'll see some kind of correction event, but just know this, they happen all the time, and we're certainly due for it. And as we take a look to see what smart money is and retail investor capital, I find this to be very interesting. These two charts compare the bear market bets versus the bull market bets. And so what you're seeing is there's finally a divergence, a pretty meaningful divergence that institutional investors deem to be smart money. They're making more bets on that top chart that are showing that they're thinking now that the market's more due to go down. And at the same time, we're seeing the retail investors starting to make more in bets in investments that their stock market's going to rise. So if I were to give another negative sign in the market, this would certainly be some of that data that I would look at to say, maybe we're a little bit overvalued, maybe this is where we would take some profits, and then look for some kind of a short-term opportunity that to invest cheaper. Because again, if the market drops 5, 10, or 20%, just know this. It's an opportunity for you to hopefully have made some changes and then readjust and then buy correctly. So let's talk a little about what returns can be expected in this final chart. When you get high valuations, what you can expect, like we have today, again, historically speaking, you can expect relatively modest historical, returns, at least looking back. So moving forward, the expectation is that returns shouldn't be for 2018 like they have been with the type of valuations that we have now. All of that notwithstanding, and you'll see I got data on data that will show, my goodness, with these kind of valuations, it's almost impossible for the market to continue to rise. I get it. But it's not going to override the fact that it's a difficult environment to invest in bonds. You still earn next to nothing in cash. Stock valuations, albeit high, they're still within reason. Balance sheets are strong. And other than some black swan events, like that corporate bond that I had mentioned before, the market looks relatively stable sitting on those 4 pillars. So I see there's a lot of difficult data. I see there's a lot of information out there that's going to create some kind of cause to panic and say, is this the time we need to jump out and get out of the market completely and entirely? The answer is no, not yet. Just be wise. These are some things that we've talked about before. We got out of energy in the beginning of 2017. We're starting to get back into energy a little bit now. We're a little bit cautious about it. We were in healthcare at the beginning of the year. We did well with that, and we're starting to maybe change our focus a little bit with the type of healthcare and biotech companies after a tremendous rate of growth in 2017. There are always going to be areas and pockets to invest in. The market's the kind of thing that you want to look long-term and look big picture at, because you don't want to be second-guessing, go all in and all out of the market. If you need help, go ahead, call us, call another financial advisor, call some institution to get some expertise and insight so that you're doing the right thing long-term for you, your family, and your finances. And with that, I'm happy to conclude our final 2017 market outlook as Henry+Horne Wealth Management, and look forward to seeing you at the beginning of 2018.